A. Identify the characteristics of the different types of financial markets and exchanges. Financial markets facilitate the transfer of funds between savers and borrowers. Primary markets are where new securities are issued, allowing firms and governments to raise capital. Secondary markets enable investors to trade existing securities, providing liquidity and price discovery. Capital markets focus on long-term instruments such as stocks and bonds. Money markets deal with short-term debt instruments like treasury bills and commercial paper. Organized exchanges provide centralized trading with standardized rules and transparency. Over-the-counter, OTC, markets operate through dealer networks and allow customized securities trading. Efficient markets enhance liquidity, reduce transaction costs, and support capital formation. Understanding market types supports financing, investing, and risk management decisions. B. Demonstrate understanding of market efficiency, strong, semi-strong, weak forms. Market efficiency refers to how quickly and accurately security prices reflect available information. In an efficient market, it is difficult to consistently earn abnormal returns. That weak form efficiency assumes prices reflect all past trading information. Technical analysis should not consistently outperform the market. Semi-strong form efficiency states prices reflect all publicly available information. Fundamental analysis cannot consistently generate excess returns. That strong form efficiency assumes prices reflect all public and private information. Even insider information would not provide abnormal profits. Understanding market efficiency influences investment strategy, valuation models, and portfolio management approaches. C. Describe the role of credit rating agencies. Credit rating agencies assess the creditworthiness of borrowers and debt securities. They assign ratings that reflect the probability of default and overall credit risk. Ratings influence interest rates and investor demand. Higher-rated bonds typically have lower yields due to lower perceived risk. Agencies provide information that reduces information asymmetry in capital markets. Investors rely on ratings to evaluate risk quickly and efficiently. Downgrades can increase borrowing costs and negatively affect stock prices. Upgrades may reduce financing costs and improve market perception. Understanding credit ratings supports debt issuance, refinancing, and investment decisions. D. Demonstrate understanding of the roles of investment banks. Investment banks assist companies in raising capital through underwriting services. They purchase securities from issuers and resell them to investors, assuming some risk in the process. They provide advisory services for mergers, acquisitions, restructurings, and strategic transactions. Their expertise supports valuation, negotiation, and deal structuring. Investment banks also engage in trading activities. They facilitate market liquidity by buying and selling securities for clients or their own accounts. They help price securities and assess market conditions. This ensures efficient capital raising and appropriate valuation. Understanding their role enhances knowledge of capital formation and financial market operations. E. Define IPOs. An initial public offering, IPO, is the first sale of a company's shares to the public. It transitions a firm from private ownership to publicly traded status, typically through a stock exchange listing. IPOs allow companies to raise significant equity capital. Funds may be used for expansion, debt repayment, acquisitions, or working capital. Investment banks underwrite IPOs and assist with pricing, regulatory filings, and marketing. The offering price is influenced by valuation analysis and investor demand. IPOs increase liquidity for early investors and founders. However, they also subject the company to regulatory reporting and public scrutiny. Understanding IPOs is critical for evaluating financing strategy and ownership dilution effects. F. Define subsequent, secondary offerings. A subsequent or secondary offering occurs when a publicly traded company issues additional shares after its IPO. It is used to raise new capital for expansion or restructuring. Secondary offerings may be primary, new shares issued by the company, or secondary, existing shareholders selling shares. Only primary offerings increase company capital. Issuing new shares can dilute existing ownership and earnings per share (EPS). Market reaction depends on how funds will be used. Timing and market conditions significantly influence pricing and investor demand. Understanding secondary offerings helps assess capital structure impact and shareholder value implications. G. Describe lease financing and calculate the net advantage to leasing (NAL). Lease financing allows a firm to use an asset in exchange for periodic payments instead of purchasing it outright. It preserves cash and may provide flexibility in asset management. Advantages include reduced upfront cost, potential tax benefits, and off-balance sheet considerations, depending on standards. It may also transfer residual value risk to the lessor. Disadvantages include potentially higher long-term cost and contractual rigidity. Leases may limit flexibility or impose restrictive terms. Net advantage to leasing, NAL, compares the present value of leasing costs to the present value of buying costs. If NAL is positive, leasing is financially preferable. Discounted cash flow analysis ensures decisions reflect time value of money and tax effects. H. Define different types of dividends. Cash, stock, and stock splits. Cash dividends are distributions of earnings paid directly to shareholders in cash. They reduce retained earnings in company cash but provide immediate income to investors. Stock dividends distribute additional shares to existing shareholders. They increase the number of shares outstanding but do not change total equity value. Stock splits increase the number of shares while proportionally reducing the share price. For example, a 2-for-1 split doubles shares and halves price per share. Stock dividends and splits do not change total shareholder wealth. They may improve liquidity or signal management confidence. Understanding dividend types supports analysis of payout policy and shareholder return strategy. 1. Identify and discuss factors that influence dividend policy. Dividend policy is influenced by profitability and cash flow stability. Companies with consistent earnings and strong operating cash flows are more likely to pay regular dividends, while firms with volatile income may retain earnings to preserve flexibility. Growth opportunities significantly affect payout decisions. High-growth firms typically retain earnings to finance expansion, whereas mature firms with fewer investment opportunities distribute more profits to shareholders. Legal restrictions, debt covenants, and contractual limitations may constrain dividend payments. These agreements protect creditors and influence retained earnings decisions. Tax considerations and shareholder preferences also matter. Some investors prefer dividends for income, others prefer capital gains. Dividend policy signals management's confidence in future performance and impacts market perception.